Well, hello there, everyone. Welcome to another edition of Tip Tuesday. Jeffrey Nance here with you. And today we are going to be talking about different types of orders, specifically market orders, limit orders, and stop orders. Now, this is a very important topic to cover here since this will be a major factor in basically every trade that you make. It will involve some type of order status. And we're going to go through and explain a little bit about how these work and how you would go out there and actually push the buttons to basically start one of these orders. So let's go ahead and present the screen. All right, there it is. So I am using Charts by Tradeway. I'm actually going to use a couple of different accounts. We're going to go up here to Research and then Chart. Obviously, we can get a sense of what the S&P is doing, the .SPX. So at this point, I'm in a Tradier virtual account. I do not have any positions because if you look under the order status, I entered an order actually over the weekend. We entered a trade. We did a market order to get into the trade. Now, the market order is a bit like going to a Walmart or something like that, where you walk into the store, there's a price tag, and that's the price that you pay. So there's a bid and an ask associated with every stock purchase, associated with every option purchase, spreads, all that, any type of exotic thing that you're trying to do. If it has to do with a stock or an option, you're going to have a bid price and an ask price. So the bid price is always going to be the lowest price. The ask price will be the higher price. Obviously, when we're trying to enter, we want to buy low and sell high. So when you're buying, buy low, sell high. And again, that never really changes no matter how exotic the trade is that you're doing. So if in essence you are using anything that is a debit, meaning you pay for it up front, you want a low price, buy low. If you're doing anything that involves a credit, then you want a high price. All right. So high credits, low debits. And this will be true, again, no matter what strategy you're using. You basically just kind of think, is this a credit? Am I getting paid or am I paying? So that's really it. Am I getting paid? Am I receiving money or am I paying money? That's going to impact what I'm going to do with this. So a market order is essentially you going up to the counter, you scan the item and it says it's $4.30. And then you just decide, all right, do I want to pay $4.30 or not? If you do, you put in a market order. That order executes very, very quickly, and you are going to have that many shares at that price. Now, what is that price? Well, essentially, if it was 430 by 431, you would probably, with a market order, get the higher price. It's oftentimes the price you don't want. So if the stock was 430 by 431, you put in a market order, you're buying that stock at 431. Now, once you're actually in that trade, there are other things that you could do, but let's not go there yet. Let's talk a little bit about a limit order. So let's go out there real quick and we'll come back to this trade here in a second. But let's say we wanted to go buy CORT. Well, they have earnings tomorrow, so we won't do that one. Let's go ahead and get rid of that. See if there's anything up. Valero. Okay. So let's say we wanted to buy Valero here. They do have a dividend, so be aware of that. It may not be the best one to buy either, especially with a $1.02 dividend. But for our case here, we'll go ahead and buy that. There's a lot of stuff that's down today. But we'll go ahead and do Valero. So if I wanted to buy the actual stock, I was at step one, I could just go over here and click buy. Now it says the action is buy, and then it says the order type is limit, and the duration is day. So a limit order means that I'm going to limit how much I'm going to pay. Okay. So in other words, I have some control over the price that I'm willing to pay. Now, a limit order is not necessarily going to get executed as fast as a market order. In fact, it's less highly unlikely that it would be executed as quickly. Can be, but a limit order is kind of like going to a garage sale where there's a price tag on an item, but depending on how bad they want to get rid of that item, they may be willing to reduce that price. Normally with a stock, the bid and the ask spreads are like a penny. Now you can see on this one that it's $129.50 for the bid, $129.59 for the ask. That's a bit uncommon. We don't see that a lot. You don't see that kind of discrepancy between the bid and the ask. But if that was the case, I may not want to pay $129.59. Okay, so what I could do with a limit order is say, well, I know you won't give me $129.50, but maybe you would be willing to give me $129.55. So this is me haggling with them, trying to basically get like a mid price. So if there was a 5-cent spread, I might try to save myself 2 or 3 cents and see if they were willing to do that. This would apply to both stocks and options, credit spreads, debit spreads, etc. You will always be using either a market order or a limit order. A limit order allows you to haggle a little bit with the price because you're saying to the market makers, you have to give me this price when buying. You have to give me this price or something lower. So if I were to put in $129.55, what I'm saying to them is, you let me into this trade. I want 100 shares, but you have to give me a price of $129.55 or lower. This could be 54, 53, 52, 51, etc. But you have to give me $129.55 or lower. That's the deal. If you're not willing to give me that, then I don't want in this trade at this time. So a limit order does give you some sense that I kind of get to control a little bit about what's happening here. But the market maker has to agree to my parameters. So, just because I stick in 129.55 doesn't mean I'll get it. Now, a lot of the times, if you'll use a limit order and you are at the mid price, they'll do one of two things. They'll give you that price, or they'll make you sit there until you change your price. And then there's technically a third as well that happens actually fairly often, is they'll raise the bid price up to your limit price. So if they raise this up to where the bid was $129.55 and the ask was $129.59, a difference of 4 cents, what they're basically telling me is, we don't want to give you $129.55. That's now the bid price. So what I would have to do is change my limit order to $129.57. So now I'm right there in between. I'm still not saying I'm going to pay the $129.59 that you want, but I'll give you a little bit more. I'll go up to $129.57. And normally when you do that, more often than not, they will execute at your desired price. Okay. Now we can do market orders for entering trades, which is like, just give me the price. Now it's going to be the price I don't want, but just give it to me. It's for fast orders. So, if your stock is moving quickly, either up or down, and you're like, I need to get in now, a market order would be the way to go. It's going to be the fastest way to get in. No, you won't have the ability to control price, but you will be getting in now. And that would be better off than maybe chasing a trade where if it's really starting to move up, see, like let's just say this stock was moving from 129.54 to 55 to 56 to 57, and I'm sitting there chasing it. It might have been better off just taking that market order rather than chasing this thing while it climbs up towards 130 and I'm still trying to figure out whether or not I'm going to get in. So if you really see that, speed is the issue, I need to get in now, market order is a good opportunity. Same thing when you go to get out. If you're trying to get in or out very quickly, a market order enables you to do that. You won't have much control over price, but you will have the advantage of speed. A limit order technically puts you in a position to have a little bit more control over price, but not so much speed. You would have to be willing to wait a little bit on most of your limit orders. Now, just because I said that doesn't mean that you can't get out of an order with a limit order very quickly. Sometimes the market makers will take your order. The limit price is good for them. They've got inventory they want to fill, and they'll be like, yeah, let's go. Let's do it. And you might find that a limit order happens very quickly. But generally speaking, you're going to need to be willing to sit on that order a little bit longer. All right, so now there's no need to set a stop order because the stop loss only applies when you're in a trade, because it's literally saying, I'm losing money. I want to stop losing money. So let's say I was in this trade. I would go down here to my positions. It would show up there under my positions. And then I would go over to the right. In fact, let's just see real quick if we can go buy something. I want to buy something a little bit lower dollar stock, though, so you guys can follow along here with me. Let's see. Let's go over here real quick to all right, let's just say we wanted to buy a box. Now, it's down today at support. I'm not sure I'm pumped about that. CPRX. It's still looking okay. Now, we've got earnings coming up, but it's still okay. So let's go buy this one. We'll do 100 shares. Let's see. It's 1382 by 1381. So I'm going to go ahead and just do a market order and just say, go ahead and get me in. Make sure we're in our Tradier virtual account. Okay, good. Now it's going to want me to review the trade. 100 shares of CPRX, market order. Time and forces day. If we're buying, there would almost never be an occasion where you would want to have an order to buy that was not a day order. When we go to stops, we can go out there and talk about good till canceled orders, but not really for a buy order. All right, I could put some journal notes in here if I wanted to, but I'm not really interested in that right now. We'll go over here to our positions. You can see that I'm already in this trade. The last price was $13.83. What I'm looking for now is to see, what price did you give me? Oh, they gave me $13.84. Okay, well, you know what? Maybe I should have done a limit order for a little bit less, but $13.84 is okay. I'm not going to do something with this in the next second here, so we should be fine. All right, so I'm in the trade, and now I would want to go out here and say, okay, I'm in this trade. I think, let's see, yeah, we're right here at EMAs. You can see the green line has popped up there because I bought it $13.84. It's at $13.83, no big deal. We'll see what happens later today. The market's down a little bit. It's kind of floating, trying to figure out direction. But if it gets up to like 14, I can make some money on this. So now what I'm going to do is say, okay, I'm in the trade. Let me go over here to positions. And if I wanted to, I could scroll over here to the far right and click close. Now, some people are initially scared of this because they're like, oh, I don't want to get out just yet. I want to see what happens with it. But remember, we're putting in a closing order, but we can do it within parameters. So again, I've got limit. Now I could say sell me at a limit order of $13.85. Well, what I would be saying to the market maker is, in this case, you now have to sell me at $13.85 or anything higher. But when it comes to the limit, this is the limit I'm willing to take. It's got to be $13.85 or higher. Now I could go ahead and do this and just say, why don't you make me an order where if this gets to 14.10 or anything higher, then just go ahead and sell that for me, and I'll go ahead and take my profits. I could do that. I could go ahead and set a limit order. I could make that a day order, which means it either hits 14.10 and sells me today, or at the end of that day it doesn't hit 14.10 and it just expires. Or I could make that good till canceled. I can just say 14.10 is a good target price. I'm going to leave that order sitting in there. And if it hits 14.10 or anything higher, it'll go ahead and do an automated order and just sell me at that price. If I were to go up here and choose market order, now what I'm saying to them, you see there's no numbers here, because basically what I've agreed to is just sell me right now, sell all 100 shares at whatever price it is. Well, all right, I would be getting out of that trade immediately. Obviously, I don't want to do that now. The other options I have once I'm in a trade are stop and stop limit. Now, a stop is called a stop market. So once you enter a price, let's say we wanted to stop out at 13.75. Okay. So what I've said to the market maker is, if the stock is 13.75 or lower, I want you to sell my shares. So as soon as that's triggered, it's executed, I'm out of that trade. So 13.75, anything lower, automated order, I'm out. Again, time and force here, day order or GTC. Most of the time, you're going to make your stop orders GTC, which is good until you cancel them. You just have to be aware that you're going to have to make some changes when you go to actually sell it if it doesn't execute at your stop order price already. Okay, now why would I want to choose stop market rather than stop limit? If you choose the stop limit, notice now I have to enter two prices. So it gets triggered at 13.75, but when it gets triggered at 13.75, I now have to set an order that says you have to sell me at 13.74 or better. Now, what would be the issue with this? Again, most stocks, it's not an issue. With options, it could be an issue. If you say trigger at 13.75, but then you've got to sell at 13.74 or better, what if they had a 2-cent spread? It was actually 13.73 by 13.75. Well, it gets triggered at 13.75, but then you said, look, you've got to sell me at 13.74 or better. And they're like, no, we would have given you 13.73, but we're not going to give you 13.74. Well, what if that stock is continuing to fall? 13.72, 13.71, 13.70, etc., right? So now you come home from work, you're like, oh man, my stock is down to 13.50. It's a good thing I stopped out. You look up and you're like, wait, why am I still in this trade? Well, because you had a stop limit order. If you would have used the stop market, you'd have been out of that trade because it would have been triggered and executed at the same time at your price or anything lower. The issue with the stop limit, again, it does give you maybe a little bit more control of the price, but you are running a risk here. The market maker has to give you your price or better. So it could get triggered and not executed. I don't want that. That's not doing me any good. I want a stop market. So if it gets to 13.75 or anything lower than that, just go ahead and get me out of this trade. I don't want to be in it anymore. It's not working. I want to be done with it. There is one more order type here. You'll notice here in the Tradier virtual account, if you were over in the My Choice Trade virtual or something else, you had a TD Ameritrade and they had their own paper trading account, you may or may not have this OCO order. OCO means one cancels the other. It enables you to enter a trade, and we actually did this on Friday when I was in Jacksonville. We were able to go get into a trade. I'll actually show you the order here. So we bought this stock, this VRRM, and we entered it, and then we said, you know what? We're going to do this order right here. This was an OCO order. And basically what we did is we said, all right, let's stop out at like 1980 or sell at 2080. So basically, I bracketed that order. I said, if the stock gets to 1980, stop market, get me out of that trade. I don't want to be in it anymore. But if it goes up to 2080 or higher, go ahead and sell me. And you can see that I woke up that next morning and I started doing some stuff. I looked around, and at 9:45, they executed that order for me at 2085. Now, remember, my order was to sell at 2080 or anything better. I actually got out of that trade at 20.85, which was 5 cents better. So that's called an OCO, or one cancels the other. And you would most likely want to make that good till canceled, because again, if you kind of set your parameter saying, here's where I should stop out, here's my target price, and you say, well, I'm going to kind of, unless something changes drastically in the market, I'm going to let this thing do whatever it's going to do. Then if your broker has an OCO capability, then it's kind of nice, because you can in some ways kind of set it and forget it and just say, well, it's either going to do one of these two things, drop down here or go up there. And if it does, then I've already got my parameters set. Unless something really, really changes, then you can just kind of ride that out. All right, so that is our tip for today. Appreciate you guys being on with us as we've kind of been able to look at some market order types, some terminology here, which should be helpful for many of you. Appreciate you being on with us, and we will see you next time.